Why does the dollar milkshake even matter? That is a question that I get more often than I can even begin to tell you. And I've tried to answer that so many times. And I often wonder whether I'm just a complete failure at explaining why it's important, or if it's just a fact that some people don't want to hear the answer. But the reason we're going to talk about that today is because this week over Twitter and some other social media interactions, I got this question not from just one person, but from more than one person. And I had a couple people ask me, well, what does it mean for us as investors? And again, I've tried to cover this before, but we're going to cover it again today because it really is important. And it may not be as important to you specifically as it is to someone else, but it is important. And I'm going to walk through why it's important to understand it. So, the first reason that I think it is important is because, really, at its core, the dollar milkshake is really a way of explaining how the monetary system works and why it works the way that it works. Now, you guys have all heard me before talk about what it is. Essentially, what it is it says that in the years ahead, the dollar would get a lot stronger versus its peer currencies, despite all the arguments to the contrary. And that even though the dollar was going to get stronger, that wouldn't necessarily mean that asset prices crashed. And it wouldn't necessarily mean that the United States went into this Great Depression. In fact, when I very first started talking about it, I said, while the dollar would get stronger, despite all the objections to the contrary, it would actually make U.S. equities go higher as well. And it would make gold go higher as well. Interest rates would rise and bonds would fall. And this was kind of the message of the very first interview I ever gave on it. And I think that is important. If for no other reason, it's important for investors. Now, if you're not a really big investor, let's say that you're a small investor, but you are an investor, you have an IRA, you have a 401k, you have a job, and you're trying to prepare for your future. Why is this important? Well, it's important for a couple of reasons. First of all, I think anytime you understand how things work and understand accurately how it works rather than just some other, an idea of how it might work, when you actually understand how something works, I think knowledge is power, and that can help you make better decisions. The other reason I think it's important is because by understanding the mechanics of how the system works, it allows you to come up with your own opinion, and it allows you to analyze things for yourself, and it allows you to come to conclusions for yourself. And the reason that is important is because if you don't have a fundamental base of your own, or a fundamental view of your own, or your own framework of how to analyze things, then you are constantly going to be pinballed around and around and around based on every conversation you have with somebody smart who does have an opinion. And your opinion is probably going to be based on the last smart person you spoke to. And here's the thing. There's a lot of really smart people who just get things wrong. And you know what? I don't even necessarily think I'm a really smart person, but I get things wrong all the time. And is it possible that I'm wrong about the milkshake? Sure, it's absolutely possible. And I test this all the time. So far, it is playing out. It's not playing out as quickly as I thought it would. And I got that wrong. And I don't mind raising my hand and saying I got that wrong. Part of the reason I don't mind saying I got something wrong is I'm not arrogant enough to think that I always get things right all the time. And because I don't think I'm always going to get things right, I don't mind being wrong. But so far, the framework is helping to understand why things are playing out the way that they are playing out. But if you don't have this framework and you talk to somebody who's really smart, even if they're completely wrong, you're probably going to believe them. And then you're going to go talk to somebody else who's really smart. And if they have a really different opinion and say, oh, no, that first guy was wrong, and you don't have your own way to check what this person is telling you against it, then you're probably going to believe that person. So if for no other reason, I think the milkshake is important because I think it has helped people understand what is happening. Now, whether it continues to happen or not, I don't know. We're just going to have to wait and see. But I think just from a fundamental understanding point, I think it's important. The other reason it's important is because, like it or not, the dollar underlies the entire global economy. The entire global monetary system is levered off of the dollar. It started out as a dollar that was backed by gold. And then that backing was removed. And instead of the world rejecting the dollar, they doubled down on it. And the reason they doubled down on it is because at about the same time, the United States removed the gold backing from the dollar. They struck this agreement with Saudi Arabia, who agreed to price their oil in dollars. And so that, ever since the whole world needed oil and energy to run their economies, everybody needed dollars in order to buy it. Or at least they needed to hedge their exposure to dollars, because if the oil price went up in dollar terms versus their own currency, they needed to have some kind of a hedge so that they could still get that oil and that energy. And since then, the use of the dollar as the global world currency has gone vertical, parabolic, exponential, however you want to describe it. The world uses dollars more today than they have at any time in history. And so I think understanding how the dollar system works and how it reacts under certain circumstances and how the end game regarding the dollar could play out is fundamentally important to understanding where the world is headed and how things will play out if and when a crisis ever develops. So it would be kind of like being a fish and saying water doesn't matter. But it does matter, because you can't get away from it. It is very, very hard to get the dollar completely wrong and then get everything else right. It's not impossible. Of course, nothing is impossible. There's always exceptions to the rule. But in general, if you get the dollar wrong, your portfolio or your business, especially if your business is exposed to dollars, is going to be affected. And so I think that's another reason why it's important. The other reason it's important is perhaps it's not as important for average Joe working in Missouri, driving a truck, and doesn't have a huge multi-million-dollar investment portfolio. But even though I like talking to the average Joe in Missouri driving a truck who doesn't have a multi-million-dollar portfolio, sometimes I do talk to those people. Sometimes I do talk to people who have globally diversified multi-million-dollar investment portfolios. And it's really important for them because they are operating on the global stage and they have exposures to different currencies. Now, you as an American are extremely lucky. The fact that you wake up every morning and only have to think in one currency, you've taken it for granted your whole life, but it is an extreme blessing. Everybody else all over the world, other than the United States, thinks in at least two currencies and probably two or three or four currencies. And so it's an incredible blessing to not have to constantly think in two or three different currencies. So if you are somebody who, thinks it doesn't matter what the dollar does because it's my currency anyway, just consider yourself lucky. But I speak to a lot of people who aren't just in the United States. I have clients in Europe. I have clients in the Middle East. I have clients in Asia. And the dollar versus their home currency is extremely important. So if sometimes I'm talking about this and you don't think it applies to you, well, then maybe it doesn't. But it doesn't mean that it's not important to somebody else. Especially if one probably easy way for me to explain this is if you remember back to 2022 and you would listen to company earnings calls. Now, if you remember in the first 6 to 9 months of 2022, equities were going down. I think the NASDAQ was down 40 to 50%. The S&P was down 20 to 30%. The Dow was in there as well. And every time these CEOs and CFOs would be on their earnings calls, they would talk about the headwinds due to the strong dollar, or they would be, under pressure on their foreign currency exposure or whatever. And it's because the strong dollar was affecting their businesses. Also in 2022, we've talked about this many, many times, but in that year, the Bank of England had to bail out its bond market. The ECB had to bail out the Italian bond market. The Bank of Japan had to bail out the JGB market, and China started to go in their tailspin from their real estate and equity market. That is all a direct consequence of the dollar getting stronger. So that is why the dollar is important. Now, some people will say, okay, maybe a strong dollar is important, but even though it's strong against other fiat currencies, it doesn't matter. So if they're all falling, if they're all melting ice cubes, or if they're all, skydivers falling out of an airplane, and it's just a matter of who's falling the slowest, why does it really matter? Well, this is why it matters. And this is really the key thing, is that every financial crisis of the last 40, 50, 60 years, virtually all of them, now somebody can probably find an exception, but in general, the reason it's important is every one of these crises was either caused by or exacerbated by one fiat currency rising dramatically versus another one. Or it had some element of a carry trade gone wrong. And we've talked about carry trades before. When you borrow in one currency that's not your home currency, and then it rises dramatically against your currency, all of a sudden you're upside down very quickly. So if you don't think that a global or a regional, either a national, a regional, or a global financial crisis doesn't affect you, well, then again, say a prayer to the Almighty that you are one of the lucky individuals in the world that a financial crisis won't affect you. But for just about everybody else, a financial crisis will affect them. Maybe it affects their job. Maybe they don't get that raise they were going to get. Maybe they get laid off, or maybe they get their work hours cut. Maybe their job disappears altogether. Maybe businesses go out of business, and then investment portfolios get affected. Maybe countries go into crisis, and they have to institute new bailout laws, or institute social new society lockdowns in order to prevent further chaos from some. But the bottom line is financial crises have far-reaching impacts that go just beyond somebody's investment portfolio. And this is why, and the other thing is, and some people will say, well, if you just own Bitcoin or if you just own gold, you're going to be fine. If you are a long-term holder and you have enough liquidity via another source, and let's pretend that you don't, let's pretend your entire portfolio is in gold and you have it that way because in the long term, fiat currencies lose value. Gold has 5,000 years of history. It can't be inflated away. It can't be, destroyed by debt. For all the reasons that everybody should own gold, let's pretend you have 100% of your portfolio in gold. Well, if that happens, and then we get into a liquidity crisis, in every liquidity crisis that we have had since the 1970s, gold has fallen. Now, does it recover? Yes. Does it recover faster than everything else? Yes. Does it then go on to even higher highs? Yes. And again, this is the reason everybody should own gold. But during that liquidity crisis, gold falls. And if you don't have any other source of income and you don't have any other part of your portfolio that is liquid or that you can draw on to either pay your bills or live your life or operate your business, then you would have to liquidate some of that 100% portfolio of gold at the lows. So if you don't want to have 100% of your money in gold, which I don't think you should have 100% of your money. I think everybody should have gold. And if you don't have gold, then you should go out tomorrow and buy some. But if you don't have 100% of your portfolio in gold, then you should probably have some of it kind of set on the side for a rainy day fund, or for some kind of a, crisis hedge, or for some kind of to be able to use it in an emergency in a liquidity crisis. And in that case, you want to own the cleanest dirty shirt. Now, this is another reason why the dollar milkshake is important, because people say, well, why? It's just the cleanest dirty shirt. It's still a dirty shirt. Okay, fair enough. Fiat currency is a dirty shirt, but why would you want to wear the dirtiest dirty shirt? So I always kind of get a kick out of it when people say it's only it's the cleanest dirty shirt. Well, I got to tell you, if I have to choose between dirty shirts, I'm picking the cleanest dirty shirt. I don't know why anybody would want to wear the dirtiest dirty shirt. And in those rare occasions where we get these liquidity crises, not only that dirty shirt all of a sudden becomes pristine, and you can use that to help out in many, many ways. So these are all kind of reasons why the dollar milkshake is important. Now, is it more important to other people, to some people than others? Absolutely. In many ways, it's more important for people outside the United States than inside the United States. I've talked to many people outside the United States who have done very well over the last 5, 6, 7 years by keeping their money in dollars, or at least their cash needs in US dollars versus their home currencies. And so that is, if you've never spoken to somebody from Argentina or Bolivia or even Australia or Turkey or South Africa or India, you talk to them and they will tell you that the dollar is a strong currency. You might not think it is because you live in the US and you don't understand what a weak currency really is. But again, for people outside the United States, I think in many ways it's even more important to them. Okay, so what does this mean for the average guy? Well, how can you prepare for this? Well, I think there's a couple things. Number one, I think the whole milkshake theory, for one, has tried to explain that even though this is probably all going to end really badly, the US on a relative place or a relative basis is a pretty good place to be. So if you're trying to decide where to allocate your portfolio, even if it's just a small 401k, you don't have to load up on emerging market stocks. You don't have to put 100% of your portfolio in gold. It's okay to have some of these things, but I think it's important because I think a lot of times the alternative media, the alternative investing space will say, you have to get out of the United States. It's an empire ready to crumble. The dollar's going to collapse. You have to get out of it. You're better off if you buy these emerging market companies who have come from commodity producing countries, and you don't want to be exposed to all the debt in the United States. And listen, it's not that these aren't important points to consider, but all you have to do is look at the chart to see that over the last 5 or 6 years, the US has wildly outperformed the rest of the world. That's just a fact. The money has flowed here just as the milkshake predicted. And I think that will continue. And I think in the end game, it'll play out even more than it has played out already. Now, will there be points along the way where that doesn't happen? Will there be points in time where money leaves the US for short periods of time? Or will the US stock market fall from, have these dramatic drawdowns along the way? Absolutely it will. This is not going to be easy. This is the other thing why it's important. It's important to understand that we are going to have some very challenging days ahead of us. And I think it's important to prepare for that. And I think it's important to prepare for it ahead of time. And so that when you get into it, you're a little bit ready for it rather than trying to figure it all out in the heat of the battle. And so hopefully my big hope is that, doing this podcast and talking to people on Twitter and going on podcasts has kind of helped people get a frame of reference to use and a framework to use as we go through this time ahead. Now, if going back to the very first point I made, what does it mean for the average investor? If I were to keep it really simple, it would mean that you should be diversified. You should have some cash, and that cash should be in dollars. You should have some gold, and that gold should be in physical form, probably not just an ETF. You should have some exposure to the equity market. Now, I don't know whether that's through your own business, whether it's through some kind of private equity that you're involved in, or maybe it's just your 401 part of your 401k or your investment fund. I don't think you should just be sitting 100% cash. You should have some exposure to equities. Now, when you make that exposure to equities, I think it should be to U.S. equities. I don't think it's worth going overseas and buying, risky companies in some of these riskier jurisdictions, especially with what's coming ahead. And then I think everybody should also have, probably some form of real estate, and whether you have rental properties, whether you own a home, whether maybe you own some farmland. But the point is, if you have those 4 investments, you're kind of ready for anything, and you will survive just about anything to come. Now, it doesn't mean it's going to be easy. Again, I think it's going to be very challenging, but I think those are the types of things that you can think about. And hopefully the whole milkshake theory has helped you think through why those things are important. Now, that was a little bit of a rant there. I hope that answered some of the people's questions that reached out to me over social media this week. What I thought we would do now is I'm going to go through some charts like what we did last week. And let me just figure out how I do this here. Hold on. I'm going to add this to the stage. There we go. I think because this last week I was in St. Bart's, as you know. I was able to do a short thing telling you where I thought things were headed. I thought, if we just go this week over some of that same stuff, it might be helpful. Oh, this first chart here, by the way, this is just, I had another guy on social media say the problem with the dollar milkshake is there's no way that you can measure whether or not it's true or not, because it's just about the dollar. Well, first of all, the dollar milkshake, the dollar is just the catalyst. Nobody should just be sitting in dollars. The dollar milkshake does not say you should just sit in dollars and do nothing else. It says you should be invested, but the dollar is the catalyst for a number of different investment asset classes. And the dollar milkshake said in the years ahead, bonds would fall. You can see that. This blue line and this orange line, this is U.S. bonds. The 10-year fell 10% over that time period, and the 30-year fell 20%. So it said interest rates would rise. That's this white and blue line. And it said bond prices would fall. That's these two lines. So far, that's measurable, and that's accurate. It also said the dollar would rise over that time. That's the orange line. It's up 10%. Now, some people say, well, that's not very much. But 10% for a currency is quite a bit, actually. And at one point, it was up 20%. And it has not caused the currency crisis. I thought we would have already had a currency crisis. We haven't. So I'm happy to admit that I was wrong there. But think about everything that has been thrown at the dollar over this time period. All the bailouts, all the QE, all the guarantees, all the jawboning about the dollar going lower. And yet the dollar is up despite everything that's been thrown at it. Not only that, but look at equities. The purple is the equities. Until just a month ago, equities and gold had done equally well. Now, in the last month, equities have had a hard pullback and gold has continued higher. So gold has been the ultimate winner over this. But remember, the dollar milkshake said in the year ahead, rates would rise. They did. The dollar would rise. It did. U.S. equities would rise. It did. And gold would rise. It did. These are all measurable. So I'm not, when people tell me there's no way to measure whether or not the theory is working, I just look at this chart. But let's bring it now to where we're at year to date. So last week we talked about the S&P 500. The Dow. Let me make sure. Hold on. I want to look here and make sure that this is showing up correctly for you guys. Oh yeah. Okay. So this is the Dow. This is the Dow Jones. I was saying that last week was a little bit volatile, and I thought we would have another volatile week this week. Well, not only did we have a volatile week, but the Dow broke below the 200-day moving average. If you remember last week, I said it was sitting right on the 200-day moving average. It actually broke below that. You can see the relative strength got down here into the 20s, kind of the high 20s, and stochastics fell all the way to the floor. Now, I will say, in general, if the relative strength had gotten a little bit weaker, this is where if you're trying to find a bottom and you're trying to put money to work, this is where you would want the stochastics to be. Ideally, you would want the relative strength to be a little bit lower, but you're getting into that neighborhood. You would also like this to be sitting near support. So if we would have had the relative strength all the way down here, if we would have had the stochastics all the way down here, and it was sitting at the 200-day, then maybe last week I would have said, that's a buying opportunity. But because the stochastics had not crashed yet, because our RSI was still relatively high, and because we were, because we had not gotten clear to these levels, and sentiment had not completely broken down yet, I said, I thought it could still go lower, and that's what we've seen. Now, if we look at the here's the other thing that's interesting on this chart. So now you're seeing the 50-day moving average is now just starting to cross the 100-day moving average. That will often be seen as a breakdown in trend. And that will often, when that happens, you will often then see further weakness. So we're just kind of right at it right now. Maybe we'll get a bounce. I don't know, but I'm just saying it's pretty interesting that right there is just starting to cross. If we look at the S&P 500, we see something similar. You see the 50-day moving average is just now sitting at the 100-day. The S&P also broke below the 200-day moving average. The RSI got weak, but not extremely weak. And again, but the stochastics again are kind of on the floor. So the stochastics are where we would want it to be if we were putting money to work. And by the way, we got a really strong bounce on Friday. So it's going to be interesting to see how this week goes. I think maybe we get a little bit of a bounce into the Fed meeting, but I don't think all the weakness is over yet. I don't think that. Listen, maybe we'll find out that this was the bottom, but I don't think so. Now here's the NASDAQ. It also broke below the 200-day. It had broken below it last week, and then it came back up and retested it, and now it fell even lower. And so, right, you can see here also the 50-day is almost down to the 100-day. It's not quite there, but it's getting close, and it'll probably get there this week. The Russell 2000, it broke way below the 200-day moving average a week ago, and then it showed further weakness this week. And again, we saw the same thing. The stochastics are on the floor. Relative strength is weak, but it hasn't totally crashed. And then it had a big up day on Friday. But here's the reason I put the Russell 2000 up here is, if you look back, it was about 3 weeks ago when the 50-day moving average of the Russell broke below the 100-day moving average. So this pink line went below the green line. Now remember, I showed that here. Pink line is at the green line on the Dow. Pink line is at the green line on the S&P. Pink line is just getting to the green line on the NASDAQ. And I said typically, or what can happen sometimes, is when that breaks through there, then that indicates more downside. Well, let's look at that on the Russell, because this happened on the Russell 3 weeks ago. It happened right there, kind of the third week of February. And then what happened? Look, just a few days later, boom, the huge drawdown. And it's just been nothing but down since then. So I'm not saying that that's necessarily going to happen here and here and here. I'm just saying it's very interesting that we're right. Markets are already weak, and now we're kind of right at these levels. Would not surprise me at all if that breaks below and we see further downside here sometime between now and the end of the month. The other thing I wanted to talk about, we touched on this last week, is the other kind of one of the reasons that we were not thinking the bottom was in yet was because the VIX was trending upwards, and it had been trending upwards for almost a month. And in the past, this past year, whenever we would see spikes, it would spike really quickly and then come back down, spike and come back down. And this was just kind of a slow draw, higher and higher and higher and higher. And we had a really kind of a high on Tuesday. It almost got to 30, and then it pulled back into the end of the week. And it was a pretty dramatic down move on Friday. And so, typically, if you're buying puts or if you're buying hedges, it's tough to buy them up here because they're so expensive. But when the volatility comes down, the hedges are a little bit more expensive. So, as this comes down, if you haven't, first of all, it's really, I think I said last week too, it's really tough to be buying puts when these are already down here, when you've already had the 5 to 10% drawdown. You don't want to just be starting to buy puts at this level, especially when the VIX is already at 30. But if the VIX is now coming back down kind of into the low 20s, or maybe it even comes into the teens this week, that might be, and if we get a little bounce in equities, that might be an opportunity for people who have not yet had hedges on to put them on. We have, during this run up and during these run down, we've been rolling our puts down. And so we don't have quite as much exposure to puts now as we did before, but we still do have some because we're expecting more downside in the weeks to come. The other thing I wanted to show you is, I saw, I think it was on Zero Hedge, but it might have been on Twitter. I can't remember. Somebody posted a chart of how much the put volume was just off the charts, meaning everybody was buying puts. And you can see here, it's kind of the highest volume in history. And that's, I think that was being put out as an indicator. Well, this has to be the bottom because everybody's all in on puts. And I had said that I was surprised about that because last week when I looked at the put call ratio, it was very tame. And in fact, it didn't indicate this at all. Well, the reason, and I didn't have my Bloomberg at the time, but when I came back and I looked at it, well, the reason is because everybody's been trying to buy the dip with calls. So this is puts, everybody betting on it going lower, but there's an equal number of people buying the dip, buying calls, expecting there to be. So this shows the call volume is at an all-time high. And so when you look at the put call ratio, it's actually at a pretty non-extreme level. But what I wanted to show you is when we talked last week, this is where we were. I think it was on the 7th or 8th that we talked, and it was very benign. Now, middle of the week, it did spike, but then with the rally on Friday, it came back down. So the bottom line is the put call volume is not extreme. It got a little bit extreme for like one day, but the put, it's not like everybody's buying puts and nobody's buying call, and everybody's extremely bared up right now. So I thought that was kind of interesting. Now we're going to finish off with gold and silver. Gold hit $3,000 this last week, and as I showed earlier, gold is the best performing asset since I first started talking about the milkshake back in 2018. You guys always like when I show the equity or the caught positioning versus gold. So the black line here is gold, and the pink line is the positioning. So this is the short positioning. So typically, as gold goes higher, then the short positioning gets bigger. What's pretty interesting is over the last month, as gold went higher, you started to see some short covering by the commercials. Now, if this continues, that's going to be a sign of, man, we could really jump higher. But you got to be careful, because what you have to remember is this pink line is a week delayed, where the black line is live. And so this point right here is as of, it came out on Friday, but it's as of Tuesday. And the gold spiked almost $100 in the last 3 days. So from, let's see, where were we at intraday? Oh, this isn't showing this isn't going to show it because it's a weekly chart. But as of Tuesday, I think gold was around 29.20 or something like that. And over the next 3 days, it went to $3,000. So it went up almost $100 in the 3 days. And I would expect that as gold rallied $100, that this short positioning was getting bigger while that was happening. So I'm actually really interested to see where this is next week, to see whether they covered into that rally or whether they added shorts back. So that's going to be pretty interesting. Now, finally, we get to silver. Silver, this is what I would have expected to see, and what I would expect we see next week, as the price of silver got back up to where it was last year. So, I think silver hit $34 last fall. Hasn't really done anything for the last 6 months, but now it's gotten back up to where it was. Not quite to 34, but pretty close. But as that has happened, you've seen the short position start to get bigger again. And again, the big, this isn't as up to date since the big move. So it'll be really interesting to see where these are at next week. Anyway, that's just kind of, where we're at this week. Hope that makes sense for you guys. Hope, going over these charts every now and then and kind of just telling you the things I'm looking at is helpful. And I hope my explanation of why the dollar is important, why the dollar milkshake is important, helps to answer some of your questions. As always, feel free to, shoot me a DM or an email, or, ask me on Twitter, or even comment in the section on the video of anything you want me to cover. And if I have the ability to do so, I will. So anyway, this has gone on more than 30 minutes now. So I'm going to let you guys get back to your weekend. It's going to be interesting to see what happens in the weeks ahead here. But whatever it is, it's not going to be boring. Okay, guys, take care. Bye.